Jim, it is great to have you help us kick off the hour. And you do right that this is a much more controlled and methodical manner than the dot-com bust, which makes it less likely to end in a bust. Can you expand on that?
Well, I just think this whole cycle compared to dot-com, Carl, has been, less substantial, less enthusiastic, less emotional, and much more fundamentally driven. And I think that's important. And as you said, the liquidation cycle, even though it's nasty here of late, this is still, I think, much more, as you said, controlled and methodical. It's more of a rounded top rather than the dot-com, which was a pure peak top and collapse. This one, I think, has been much more slower to unfold. If you look at the relative price of S&P 500 technology stocks, they've been in a trading range really flat for the last 2 years, rather than the spike top of 2000 that then collapsed. So the liquidation's a lot better. I also just find a lot of other differences. If you look at the concentration that's already been taken out of this tech bubble, it's pretty substantial. If you look at FANG weighting, it was as high as 14% in 2020. It's down to 9.5%, which is the same weighting relative to the S&P 500 it first was in 2018. If you look at the ARK fund, Cathie Wood's headliner, if you will, its relative performance has collapsed back to where it first was in early 2017, almost 5 years worth of no relative performance. And then if you just look at the weighting of the overall S&P 500 tech index, Carl, in 2000, that weighting was 34% at the peak. But the companies that made up that index, their sales only comprised about 8% of nominal GDP. So the market cap weighting to economic weighting was 4 times higher. Today, the weighting's 27% of market cap, but 18% on an economic basis, much more fundamentally supported, if you will, overall. So I just kind of think, the valuations reached 55 times future earnings in 2000. They reached 30 here. They're back to 22 forward now. It just seems like a much different cycle with much less overexuberance, if you will. Small caps really haven't had near the performance in this cycle that they did back then. Back then,
Sure.
You didn't need any earnings. You just needed a story and a dot-com behind your
Sure.
name. They haven't participated that way this time.
Yeah, I did notice this morning Goldman's non-profitable tech basket, Jim, has now had its biggest drawdown ever, 68% off the peak. Isn't one of the glaring similarities to that period the number of companies that were expending and making profits expendable at the expense of growth?
Yeah, I think that's the biggest difference. I mean, this one's more fundamentally driven. I just think there were so many companies, I said, that had nothing but a story and a dot-com behind their name, and they were running ahead. And we have some of that today, but far less. As I said, most small cap tech haven't really been the players. It's been mainly large cap tech, and most of those have had strong fundamentals. For example, the relative price of S&P 500 Technology Index today, Carl, is about where it was at the top of the dot-com. But the relative earnings of those companies today are 60 to 70% higher than they were at the top of the dot-com. There's just more fundamental gravitas here.